All right, let's talk about learning a new language. And no, I don't mean Spanish or Japanese, but I promise you this one is just as powerful. It's the language of the stock market, and it's spoken entirely through charts. It's called technical analysis, and honestly, it's a fascinating way to understand what's really going on with a stock.
To get what I mean, just imagine this. You're in a massive, buzzing food market, somewhere you've never been before. You don't speak the language, everything smells absolutely incredible, but you have no clue what's what. So what do? How do you find the best place to eat?
Well, you've basically got two options, right? Option one, you become the investigator. You go to every single stall. You inspect their ingredients, you try to ask about their cooking methods, maybe taste a sample from each one. It's super thorough, but man, that's going to take forever. That's kind of like fundamental analysis, deep diving into a company's financials. But then there's option two. You become the observer. You just stand back, take it all in, and you walk straight over to the stall with the longest, happiest-looking line. You trust the wisdom of the crowd. And that, right there, is the heart of technical analysis.
See, technical analysis isn't really about a company's profit margins or its CEO. It's about studying the collective psychology of everyone in the market, all their fear, all their greed, their hope, their indecision. And you know what? All of those emotions get funneled into one single place, the price chart. We're not reading a boring annual report, we're reading the crowd. So, if this is a language, then we've got to start with the absolute basics, the alphabet. What are the building blocks that tell the story of a stock's price? Let's dive in.
And believe it or not, the entire alphabet has just 4 letters: O, H, L, and C. That's it. Open, high, low, and close. For any time period you pick, whether it's a whole day, an hour, or even just 1 minute, these 4 prices give you the entire picture of what happened. It's really that simple.
So how can we possibly see all 4 of these letters at the same time? Well, the most popular way by far is something called a Japanese candlestick. Just look here. First, you mark the open and the close price. Then you draw a box between them. That's called the body. Easy enough. Then you just draw a line up to the highest point the price hit and another line down to the lowest point. Those lines are called wicks. And just like that, you have one simple shape that tells you the entire story of that period.
Now, what's really cool is that these candles instantly tell us who won the battle for that period. If the price closed higher than it opened, the candle is usually green. We call that a bullish candle. It means the buyers were in control. But if the price closed lower than it opened, the candle turns red. That's a bearish candle, and it tells us the sellers won that round.
Okay, so we've got the alphabet down. Now we get to form words and sentences. This is where it gets really fun, because when you group these individual candles together, they start forming patterns that tell a much bigger, more interesting story. So yeah, just like letters form words, single candlesticks come together to form patterns. And these patterns, they give us these little clues about the overall mood of the market. They can hint that a trend is going to keep going, or, and this is the really important part, that a trend might be about to turn around completely.
Let's look at a real example. This one's called a bullish harami. I know, the name sounds a little weird, but spotting it is actually pretty simple. You see a stock in a downtrend, and you get this long red candle. But the very next day, a small green candle forms, and its entire body is tucked inside the body of that first big red one. This little pattern is a hint that the selling pressure might be running out of gas.
So what's the story it's telling us? Well, the market was falling, and falling hard. But on that second day, the sellers just couldn't push the price any lower. It's almost like the chart is whispering to you, hey, the fall is stopping. It looks like buyers are starting to step back in.
Okay, let's flip it. Here's a bearish example called the hanging man. You'll see this pop up after a strong rally. It's got this little body up at the top and a really long lower wick. Now, what that shows is that during the day, sellers managed to shove the price way, way down, even though the buyers clawed it back up by the end. It's a major warning sign.
The story of the hanging man is really a story of doubt. That strong climb to the top is suddenly being challenged. The market is basically telling you, whoa, this rally might be running out of steam. Sellers are definitely starting to test the waters up here. All right, so we can now read some basic words and sentences on the chart. The next layer to this is to understand the actual map, the landscape of the chart itself. We need to find the key landmarks where these big battles between buyers and sellers tend to happen. We call these support and resistance levels. So think of resistance as a price ceiling. It's a price level that the stock has hit before and then fallen back down. Why does that happen? Because a lot of sellers look at that price and think, yep, this is a great place to sell and take my profit. and that flood of selling pushes the price back down. And you guessed it, support is the complete opposite. It's a price floor. It's a level where the price has bounced up from in the past. Here, buyers see the price and think, wow, what a bargain, and they rush in to buy, which creates a floor that stops the price from falling any further.
So why do we care so much about these floors and ceilings? Because they become the foundation for your entire trading plan. You can look for opportunities to buy near a support floor, you can set your profit target near a resistance ceiling, and, this is absolutely crucial, you can place your safety net, your stop loss, just below that support level. This is how you define and manage your risk before you even think about placing a trade.
Okay, we've covered the alphabet, the patterns, and the landmarks. Now, let's put it all together into a really simple, actionable checklist that you can start using right away.
But first, a really important reminder. Technical analysis is not a crystal ball. It does not predict the future with 100% certainty, not even close. It's a tool that helps you make smart, disciplined decisions based on probabilities. And a simple checklist, well, that's your absolute best friend for staying disciplined.
So here it is, a simple 4-step checklist. Number 1, find a clear candlestick pattern. Number 2, check its location. A bullish pattern near a support floor is way more powerful than one floating in the middle of nowhere. Number 3, you've got to have a plan. Know your entry price, your target price, and your stop loss price before you do anything. And finally, number 4, which is by far the most important step of all.
You have to ask yourself, is the potential reward actually worth the risk? We measure this with something called the reward-to-risk ratio, or RRR. It's a simple calculation. You just take your potential reward if you're right, and you divide it by your potential loss if you're wrong.
Now, a fantastic rule of thumb for beginners is to only take trades where you can make at least 1.5 times what you're risking. You should literally ask yourself, for every 1 rupee I am putting at risk on this trade, can I realistically make at least 1.5 rupees in profit? If the answer is no, you don't take the trade. Period. You just walk away.
Now, I want you to remember this quote, because it's probably the most critical lesson in all of trading. Even the most perfect-looking pattern at the most textbook support level is a bad trade if the reward doesn't justify the risk. At the end of the day, managing your risk is everything.
So, there you have it. The basic alphabet, the grammar, and the structure of the market's language. It's not about being a psychic or predicting the future, it's just about learning to listen, to observe, and to make disciplined decisions based on what the crowd is telling you right here, right now. The only question left is, now that you know how to listen, what is the market telling you?